Okay, and
I want to figure this thing out, this WebEx business.
okay, go
All
ahead.
right. So, yeah, can I control from here the back and forth? Is that possible?
You can, but yeah, I can. Yeah, but the problem is I am letting people in. So I will just tell me. I will move the slide.
Okay. So, just so you know, this is Coach Rene here. What I've done is I've pulled some slides from material that my company and my company and I do out there as a side hustle. We'll go to the next page, Nari. Again, this here is only for amusement, right? I'm not here to tell that I'm not a stockbroker. I'm not an analyst, whatever it is. I'm just a guy who figured things out, along the way through my lifetime in the industry. Let's go now. Okay, let's go to the next one. You go to the next one as well. This is just like some things I have to put. Okay, so about me. So I come from Cameroon. I mean, I grew up in Canada I went to Canada for my studies. A comp sci PhD. I was teaching there for a while, and then I started doing consulting. Throughout my travels, I ended up working for Nasdaq OMX, and I was a developer on the options platform. That's where I really got exposed to options trading. I was there for about 10 years. I managed to learn options trading, the options quote, whatever happens between, when you send a quote out to the market, what happens there, how an option is filled, and so on and so forth. My day job is I'm a software architect. I work from Amtrak. That's my day job. But really, my real job is I'm a hustler, right? I do options coaching, stock trading. I teach. I don't manage portfolios of people, but I help friends, rebalance their assets sometimes. I'm also a life insurance, agent, in Pennsylvania, Delaware, Maryland, and Virginia. And I have some partners. We own an academy to teach stock trading and then options trading. And you can find me on LinkedIn. I have my portfolio there. So my toolbox, these are the things that I use, right? These are my tools, okay? I'm not here to promote these two, but this is what I use. For my trading platforms, I have two main ones. Works, which was designed really for options trading. I also Thinkorswim. What's the difference? Well, the guys who built Work actually built Thinkorswim. When it was bought by TD Ameritrade, they were bought out. Tom Sosnoff and his team went off to build a new platform called Works. So if you like Thinkorswim, you love Works. It's much simpler to use, very intuitive and whatnot. For my charting platforms, I use two. TradingView, which is a very simple charting platform with a lot of built-in indicators, and also use Thinkorswim sometimes. Now, TradingView is not free. You got to pay to have many features there. So when I get frustrated with my TradingView, I go to Thinkorswim to have multiple charts and all those studies in there. For my stock screening, I use a Finviz, and then also use Thinkorswim. The one thing I didn't put here is I also use barchart.com for my options screening as well. Go ahead, Nari. So options really are all about managing risk and trying to get an edge on the market, right? So there are three things that you have to really understand, really master to trade options effectively. The first one is the option delta. Okay, what is a delta? The delta has many meanings, but these are the ones that I give out to people that are very simple to understand, right? If you look at an option delta, if you look at any options screen, you look at all the options there. Every single strike there, every single contract has a delta. The delta goes between 0 and 1, which is really 100, right? The delta means a lot of things to many people, but really, one view is it tells you the odds of your option that you're buying and expiring in the money. Okay, so if you buy like a 0.5 delta, that means like that your option has 50% chance of expiring in the money. If you're a market maker, because you have to hold shares, technically hold shares to hedge against an option being bought by somebody or sold by somebody, the data represents the actual number of shares controlled by an option. Now, in theory, an option controls 100 shares of the underlying, but that's not quite true. It is only true for a delta of 1. Any other delta tells you that the number of shares you control. So if you buy an option at 0.5 delta, that means the option actually controls only 50 shares, only controls 50 shares, of underlying. Another view of delta, it tells you by how much your option gains or loses in price when the underlying goes up by $1. For instance, if you have a 0.5 delta option, if a stock goes up by $1, your option goes up by 50 cents. Okay, that's basically how you look at the delta. So the delta is very important when you're trading options. Always look at it. Okay, go ahead, Nyari. The next one is theta. By their nature, options are decaying assets. What does that mean? When you buy, the moment you buy an option, it started losing value until it expires. So theta measures the rate of decay of any option out there. When you buy an option, if you're buying like let's say a single, like a naked option, you buy a call or a put, whatever it is. If you don't pay attention to your delta, to a theta, your option will decay very quickly. And usually, when you have the in a very high IV environment, options are expensive, and then you can lose your money like quickly like that. So look at the delta and the theta as well. They're very important, right? So if you are an option buyer, which most people are because they don't have enough size in the account to sell premium, you got to just look at that theta carefully. If you're an option seller, you love theta because theta for you is how much you make every day as time goes by, right? Of course, if you look on the right of your screen, you're going to see that curve there. Theta really drops dramatically in the last 21 to 30 days of an option's lifespan. So when you buy an option, look at how much time you're buying. If you're buying a 45-day option, technically, I always tell my students, make sure that by day 21, close that position, because after that, you start losing money quickly. Absolutely. So delta, crucial. Theta, your time decay. Because these things are going to come into play shortly when we start talking about spreads and whatnot. If I
So,
go to
Coach, I got a question.
Yes.
So, this is a very good point, right? So, when you are buying, say, put options or whatever, right? Uh, I think many of the trading strategies, they recommend buying like a month or something, right? So there you are losing the value. So whenever I buy put options for portfolio protection or something, I buy like 3 or like 6 months rather than 1 month, right? Because the theta value, because of that, it keeps declining as your curve shows.
Correct.
Yeah.
Absolutely. That's very good. See, my average trade is 45 days. Okay. I can go leap like 6 months, sometimes into a year as well, depending on what I'm trying to do. If I'm trying to sell premium against my long call, I go like 1 year out, and then start lowering my cost basis by selling covered calls on that long option. Yeah, but usually don't go less than 45 days. Otherwise, basically just losing money, throwing money out the window. Now, unless you're a day trader or a gambler, you can do like a buy a 2-week option, depending on what you're trying to achieve. But normally, for people who are really conservative in terms of trading and investment, go at least at a minimum 45 days, at the very minimum. This is very important thing to understand. All right. If you're an option buyer, look at your theta decay. It's extremely important. Very important. Go ahead, Nari.
I have a question also here. On the contrary to this side, if you are actually option seller, then you want to be in this position, right? Because you will be gaining more in the last
Correct.
days.
If you sell options, then you sell short-dated options like 30 day or less. Correct. Correct.
Yeah, that's what he has got it here. Yeah.
Yeah. Yeah. Okay. Vega, volatility, implied volatility or volatility rank. This is another thing. I don't know if you guys have seen this, this thing sometimes in the past. You buy an option, and then something happens, the stock price goes up, but the option barely moves. Because when you bought that option, you didn't pay attention to volatility. If you buy an option in a very high IVR environment, and then volatility drops, let's say after earnings, the option just drops in price like a stone, right? So when you are trying to buy an option, find out where you are in that stock cycle. Are you coming to an earnings coming up soon? Get out of your option before earnings. Never hold an option through earnings unless it's like a leap option. If you have one of those like a 45-day option or 30-day option, get out before earnings, because earnings are a binary event, okay? Either the good or the bad. Whatever happens then, there is no more uncertainty. Volatility, basically uncertainty. We don't know what's going to happen. Once the event is decided, there's no more volatility, it just drops. It is called, it's called IV crush. So when you look at buying an option, go to barchart.com, look at the IV rank. It tells you whether you're trying to buy an option that is cheap at this time or expensive. Now, if you listen to people like Tom Sosnoff, they tell you don't buy anything above 25, for IVR. But me, I go up to 45 sometimes. But anything above 50, I don't buy. Then I sell instead of buying. Because if you buy an option above 50 IVR, you basically throw money out the window. Okay, so that's what I'm trying to say here. So this is a very like I said, this is a very quick webinar, but really, when after this webinar, take time, go online, look at Delta, look at Theta, look at Vega, study those three things. You'll save a lot of money down the road. Okay, thanks, Larry. Let's go ahead next time.
So I think this Vega is very important, right? So I never thought about it. Like near what you're saying is near the earnings date. So is it then better if you are selling options? Is
exactly. Now you get to a point here. Option sellers love earnings, right?
Yeah.
The days going to earnings, you have like the IVR is go through the roof, right? They sell. After earnings, it drops, and then those who sold options make money quickly because now, the IVR is gone, and option the IV crush, right? So if you're gonna buy an option, don't buy it like 2 weeks before earnings. You're paying too much. Buy it like months ahead. Okay. Again, unless you are trying to play earnings and then you are like a short-term trader or something like that. But if you are a long-term trader like I am,
problem is when you are selling option just before the earnings, right? So it can go either way, right? So the stock can go drastically up or drastically down.
but
So
if you sell an option right now, once you sold it, you have a premium. It doesn't matter what happens after that, right? It doesn't matter.
I know, but you are committed, right? So if you sell a put option, right? Then you are committed to buy it back.
That's why those guys never do naked options. They always have spreads.
Right.
That's why we're getting to spreads.
Yeah, spreads. Yeah. Okay.
Okay, so let's talk about spreads, okay? Because to really get into like advanced option strategies, you got to talk about spreads, okay? So what is a spread? Basically, picture let's say you're trying to buy. Let's say you buy a long option, you buy a call option, right? You pay a premium. If that option, if the stock price drops dramatically, the option loses value. So if you have a stop loss, you're gonna stop out and then you're done. But if all goes well, the stock goes up, you make a lot of money. However, there's a way for you to basically limit your exposure by buying an option and selling an option at the same time. Basically, you buy the cheaper option, which is, let's say you're buying a 65 call, for instance, then you sell, a more expensive option so that you protect yourself like insurance. That means that if you buy a call and sell a call in a particular series of an option, whatever happens in between, your loss is very determined. Okay, your loss is determined when you buy. All you can lose is your premium. That's it. Okay, but if you buy a naked option, you can lose the whole thing if, let's say, the company goes bankrupt, for instance. Whereas if you buy a spread, you only lose that much money you put in there. So spread allow you to basically limit your exposure, but also you cap your benefits. The question is, What do you want? You want to have like, you want to go like, full bore, pay the full premium and get the full gain, the full move? Or you say, you know what? I'm going to pay less money, but make okay money without hitting a home run. The choice is yours. You can do spreads on the call side or on the put side, and depending on what's happening. We'll see exactly how those scenarios play out. But this is where spreads are important. Spreads basically take away time decay, because you basically buy something and sell something, it'll cancel your time decay. That's why spreads are also very important here. If you buy a long option, you can have a huge time decay in there. But if you buy a spread, the time decay is reduced to almost nothing. Also depends also on the IVR as well. Okay. So please stop me if I'm going too fast, and because I want us to basically have a discussion here like when this is done. Go ahead.
So everybody clear on spread?
Rene, I have one question. Now, I agree with the spread, but it's not limiting the loss to your premium, is it right? It's basically limiting the loss, but it's definitely bigger than the premium, is it right? So
no.
You might make a $2 premium, but then you might say like, no, I want to put like $1 and then block or put an insurance. But no, the strike price is going to be considerably different, is that right?
Well, you are talking about selling a spread. We'll get in a second, right? We'll get in a second. Okay. If you're an option buyer, your mark loss is your premium.
Oh, okay. You are basically say buy now, because I can see here.
Yeah, sorry. Yeah.
Only on the buy side. Okay. Not on the sell. Okay.
If you're on the long side, your max loss is your premium.
Yeah.
If you're on the short side, your max loss is your width, the width of your strike minus premium paid.
Yeah. Got it.
That is your capital requirement. It can be huge depending on the stock you're trading. Does that answer your question?
Yeah. Thank you.
Okay, cool, no problem. Okay, here is an example, a very simple example here of an Amazon long call, right? Here, I'm buying a 3380 call at 0.53 delta. My capital requirement here is almost $17,000, right? Look at the time decay. Okay, this option expires in 47 days, but each day that goes by, I lose $161, which means that, if the stock never moves, which is not the case for Amazon, but let's say that the stock never moves, it sits there for 45 days, each day you lose $160, in time decay. And then you pay $17,000 in cost, in premium. That is extreme. Now, look at the exposure here. Let's say, which is unlikely, but let's say that Amazon goes bankrupt overnight. What happens? You lose your whole $17,000, gone, poof, just like that. Totally gone. So if you are going to trade Amazon on a naked call, pay attention to your data over there. That's your time decay right there. Okay. Now, of course, the max profit they say is unlimited, which is not quite true, but it is whatever it's going to be. But look at your max loss here is what you paid for, what you paid, $17,000, which means the whole thing went bankrupt. Then go to the next slide, please. Now, unlike a naked call, if you buy a vertical spread, let me go to the next slide here. So this is the same example. Here, I'm on the long side, I'm buying a vertical spread on Amazon, right? I'm buying the 3380 call, and I'm selling the 3410.
Sorry.
It's okay.
Yeah, there is some noise, so I was trying to.
I don't know who's making the noise there. So here, I am buying a spread. I'm on the long side, right? I buy the 33 call, then I sell the 3410. Look at my theta, is $1 a day, okay? Now, my max loss is the premium paid. But look at the profit as well. It is also capped. This is where basically, all you can lose is what you put in there, because I'm on the long side of the trade, right? So this is how you can trade Amazon without going broke.
Yeah.
You can trade Amazon, you can trade Tesla, you can trade all those big.
Sorry, it's very difficult to follow, I think.
Yeah, I think
guys,
Poonam,
like
Poonam,
your phone on mute. Yeah.
Poonam. sorry. Because I'm trying to manage the participants and
It's
thing.
okay.
It is,
So, I mean, I trade Amazon all the time. I also trade Tesla all the time. The way you trade them, you trade those names if you're using spreads. Okay. Here I'm risking 1,500 to make almost the same amount, 1-for-1, which is not bad at all. It's not about a risk reward ratio right there. Let's go to the next one, please. Okay. Now,
Coach,
yeah,
could
ahead.
we go back to the previous screen, and can we just point out the different numbers that we were looking at? I can see the 3380 and 3410. And
do you see my mouse? No, you guys see my mouse, right? Now you go to the green line. The green line here, in the green line, I'm buying, right? See the buy. I'm buying one lot at a 3380 strike. It's a
yes,
call, okay? Then I go down 4 strikes and I sell one lot at a 3410 strike.
Yep.
You got that?
Yes.
So the difference in there will give me a premium of $1,500. And my max profit is right there next to Theta, is right there. The profit is 14.95. That means that if I end up in the money, that's how much I'm going to make.
Okay.
In the 47 days. Does that make sense?
Got it.
Okay. Thank you. Right. So
you mentioned, sorry, a quick question here. You mentioned that you will do that in case, right? In case you're afraid that to basically hedge your risk that the company, something might happen with the company, but it's unlikely, right? For these kind of companies. Why would you do that? Why would you do the spread in case of Amazon?
Also, okay, Nadi, please go back to the previous slide. No, previous slide. Go back again.
one more?
No, go back. Go back.
Yeah.
Keep going back.
Going back?
Yeah, going back, please. Sorry, I want to show him something. Keep going back again. Okay, here. Oh, sorry. Go forward.
Yeah.
Here, if you look at what I said online, what is that again? Look at the upper right point. Spreads give you the opportunity to trade large cap stocks by reducing the premium you pay to open a position.
Okay, makes
If
sense.
you want to, right, that point there, that's why I'm doing that.
Makes sense.
I don't want to put too much money on the table to make money. I want to put like let's say $1,000, make $1,000. To me, that is good risk reward. Instead of putting in 14 grand only to make $1,000. You see what I'm saying?
Yeah, that makes sense. Thanks.
That's why I use that. Yeah.
Yeah. So Rene, in this example, and if you go back to that slide, sorry, stay there. So what you're saying is, no, you are paying not to buy the option. You're paying like I don't know. I can't see the screen better, but it's like about $1,100 or so. That right? That the green box.
No, I'm paying $1,500.
Okay, $1,600 there.
$1,500, yeah.
Okay, and then the red boxes, you're collecting a premium of.
Oh, I'm so sorry. Okay, that is the green line there is the strike. I'm selling the 3380 call. That's a strike.
Oh,
So no, I'm buying the 3380 call, and I'm selling the 3410 call.
Yeah, so there's a difference of $30 on the strike price. That's the maximum loss, is it right? That's the $3,000 loss, is it right?
Oh no. The max loss here is you take the width of the strike. What is that? 3410 minus 3380.
Yeah,
right.
It
So
would it be the $3,000 minus the premium? Is it right? $3,000
minus premium.
Correct.
Correct.
Okay,
1495. So
That's the
maximum
max loss.
Yeah. So that you're saying that's the kind of the premium that actually you're making in the red box. That right? You're collecting the premium and the difference is 3,000. So technically maximum loss is
No. Here I'm paying. I'm on the long side. I'm buying. This is a long call. Because okay, whenever you sell is cheaper than whatever. So whatever you buy costs more than what you sell. You end up having a debit. When you're on the debit side, you're on the long side.
Yeah.
Okay. So in this case here, I am net. See how you look at below, say buy to open, and then sell to open.
Okay.
When I'm buying it, so that means I'm paying. If I flip it, then it becomes a credit spread where I'm getting a premium. If I sell 380 and buy 34.10, now I'm getting money as a premium. Now I'm a premium seller. In this case here, I'm buying because I am net debit instead of net credit.
So yeah, he's selling 3380 buy to open and 3410 sell to open, right?
Yeah.
So basically,
I'm buying to open 3380, then I'm selling to open 3410.
Yeah.
So basically, you're saying that we are paying $1,500 from our pocket to make this trade.
Yes, and then my potential profit is almost also $1,500 as well. Correct.
So how would we be in profit? This is going away from our pocket right now.
Ah, good question. So now look, now go right off the data line. You see the max profit there. Go where they have the data box. See the max profit there.
Yeah, max profit is 1495.
Okay. Now, if the stock price keeps going up to 3,400 and that kind of stuff, my profit increases. So remember, right now, I am buying in the money and I'm selling out of the money. Right? The 3380 is in the money right now because
Right.
I am below the strike price, below the stock price, right? And I'm selling out of the money at 3410. As the stock price goes up, okay, think of a call option, okay? Okay, for now, forget the red line for now, for a second, okay? Say you buy the 3410, sorry, the 3380, right? You want to buy a naked call. You bought that. You're going to pay something like, I think 17K we saw in the previous slide. And Nari, please go to the previous slide, please, Nari. Go to the previous slide. Okay, here. Let's say you want to buy Amazon call, expiring in 47 days, correct? You're going to pay out of pocket $17,000. You see that right there?
Yeah.
Lower right? That is how much you pay. You pay out of pocket $17,000. You agree with me on that?
Yeah, because you're trying to buy Amazon.
Correct.
If the price goes at 3380, you will buy it at 3380.
Right. Now, if the price goes to 3390 or 3400, now you're making money, correct?
Correct.
But what if it goes down? What if Amazon goes down? And you don't know how low it will go. What do? You start losing money, correct?
Correct.
So you want to limit your downside exposure. Basically, you buy insurance, say that, listen, I'm buying a lottery ticket right now. I want to make this kind of money, but if something goes wrong, I need insurance. Well, that insurance will limit how much you make. You can only make so much. That is, your profit is capped. Okay? That's what I'm showing you in the next slide, where instead of doing the naked call, you do a spread. Right? Here, naked call, I'm paying 17K. In here, I'm doing a spread. I'm still buying the 3380, but I'm selling a 3410 as a protection.
Okay.
That means that if Amazon stock falls for whatever reason, the most I can lose is my $1,500. But if the stock price goes up to infinity, the most I can make is $14.95.
So in this scenario, it's better that Amazon stays between 3380 and 3410.
No, you want Amazon to go beyond 3410.
Yeah, but then you will get called, right? Because
No,
you sold a call on it.
Yeah, but that's what I'm saying. In a spread, the most you can lose is a premium you paid on the long call.
Okay.
On a debit spread, the most you can lose is a premium paid. It doesn't matter if Amazon goes to the moon. You don't care because you are
yeah.
Your loss is capped.
Correct, because your short call will be in the money, and so will your long call, right? They make a difference.
Yeah.
They will cancel each other's out. So
But
the most you can lose,
in
the
this
most you can lose
scenario,
It works both ways, right? See, your profits are also capped.
Correct. Exactly.
Losses are capped, but also profits are capped. And so that means you do a call debit spread only if you think it is going to go up, correct?
It is your way of saying, I mean, I don't have money to trade Amazon, but I will try with whatever money I have. Basically, you risk less to make good
Okay.
money. You don't know how high Amazon will go.
Right. Okay. So you're limiting your risk and you're limiting your reward also.
Correct. That is
See,
correct.
if you did not buy this red selling call, right? Then if Amazon goes to 4,000 or something, then you get the full benefit.
Correct. Exactly. But the question is, what is your risk? Your risk is $17,000.
Yeah, $17,000 you can lose if the stock goes down or the market goes down, then you lose all the 17. Whereas here, if the market goes down, you are still losing only $1,505.
Correct. That's all you lose.
So
But
okay, so
Nari,
this
you said
strategy.
something important that you would do this call debit spread assuming that Amazon is bullish, is it's going to go up. Is that correct?
Right.
Yeah.
We're going to get it in a second. Exactly. This has a bias, okay? Whatever you're using a spread, whether it's a bull call or bear call, you have to have a bias in your assumption in your cases. You're going to have a bias. Let's say, according to my analysis, Amazon right now is oversold. It has to go up in the next, I don't know, 30 days or whatever it is. I will buy a debit spread because it's a low IV. First of all, it has to be low IV, number one, because when IV is low, premiums are cheap, right? I buy my debit spread and sit trade it. After 45 days, it'll go up, make my money, and then walk away. But if Amazon is at all-time high, why buy a debit spread? It makes no sense. Go buy a put spread.
But here the IV is 65.6, right?
If IV is right now, this IV right now is very high anyway. Right now, IV rank is very high. So buying a call right now doesn't even make sense. You're right. That's the IV rank right now, 65.6. That's high. But the point of this exercise is to understand the power of spread, because spreads are used to construct complex trading strategies. You can't do anything with options without spreads. You could buy a naked call or a naked put. Fine, do that if you want to, but that's too much exposure, too much risk.
So what percentage of your spread trades are profitable?
Okay. My credit spreads, I cash out at 50% of the debit of the premium received. On the debit side of things, if I buy a 45-day option, for instance, if I day 21, I don't make money, I'm out. So I'm profitable with most of my debit spread because I enter the trade when the time is right. I don't buy a debit spread when a stock is at all-time high. I don't do that. I don't.
Okay. Right, more chances of it going down.
Correct.
So, and what is the expiration date? How do you come up with the expiration date?
How do I decide?
Yeah.
Okay, if I buy something like, let's say, okay, in terms of my portfolio, I have Amazon, right? I buy Amazon like a long call. I pay like 30 grand Amazon long call, and every week I sell a cover calls on that to make money. It depends on my strategy, but in general, I go 45 days at the minimum. As my aspiration. In general.
Okay. Okay. So,
Rene, covered calls are 45 days, or the leap option is 45 days?
No, the cover. So for Amazon, my leap is like 1 year out.
Okay. And the
covered calls are weekly. Because okay, Amazon is a high ATR, high beta stock. I make money weekly. I make more money every week than going monthly.
No, the covered calls you do week. So you are not doing a 45 day then. You are doing every week covered calls.
I sell a cover call every week on my leap call. Yes.
Okay, so that is a different strategy. That's not the 45-day strategy.
No. The 45 days is when I buy a long call as a regular spread trade. If I want to collect premium over time and then see my stock go up, right? For instance, like a month or so ago, Amazon was down a month or so ago. Was very down. I think it was back in I think October or something, October, September. I bought 2 long Amazon call, like leap calls, naked calls, and every month, so every week, I collect like $1,000 on covered calls.
But again, the stock can go substantially within a week, no, and it can cross that sell call value.
No, because I sell out of the money always. You always say out of the money calls always. All cover calls are always out of the money.
Yeah.
Always.
Okay. No. Again, I don't want to digress the topic, but again, okay. Now we'll come
So
to that when we go
when
to the.
you're, there's a question here, right? So when you're bullish, you do a credit. It's a call debit spread, right? And when you're bearish on a stock, you'll do a put debit spread. Is that how you do it?
There's a table here we look at when we get in a second. But in general, I mean, he asked me one question: how profitable are my debit trades? I do very few debit spreads because, I mean, because I'm here to collect a premium and lower my cost basis, right? If I'm bullish on Amazon, like Amazon is very, very low, like oversold, I'll buy a leap call on Amazon, pay like $25,000 and then hold it there, and every week make $1,000 on selling covered calls. Okay, so I make about $4,000 a month, in premium on my Amazon long call. If the stock price goes down, which is fine, but I have a whole leap call, I have time to make it up over time. Now, to your question, if I'm bullish on a stock, right, I will buy a long call, basically a bull call spread, right? If I'm bullish on a call, if I am bearish, I will buy a spread, a put spread, or if I'm an option seller, I will sell a call.
Right. So that was going to be my question, right? So depending on if you're bullish on a stock, right? So you can either do a call debit spread or you can do a put credit spread.
Correct.
Right. So which one, is there any preference for one versus the other in terms of strategy or being profitability?
The difference is the capital requirement. Okay. When you buy a bull call spread, the only thing you put in there is your premium that you pay. Okay. That's it. If you sell a put credit spread, what you get in premium is what you get. But because you have exposure, you need a lot of money to put in as collateral. It's called a capital requirement. So if you have a large account, okay, you can sell put calls at like, let's say like a 0.2 delta, I think. 0.2, 0.3 delta are safe, right?
I didn't get that. Sorry, could you repeat that?
If you have, let's say you have like a large account, okay, and then you can afford to, let's say, to sell, like, you can sell Amazon, maybe, let's say SPX, for instance, SPX, okay, you can sell SPX at 0.2 or 0.3 delta, sell a put spread there, okay. For each dollar that you collect in a put spread, depending on the underlying, you need to put down about $500 to $1,000 in capital requirement, because you are short the market, right? You got to put some insurance for the broker, I mean, for the owner, risk management. Selling premium requires you to have a large account so that you can handle the loss if it does happen.
Okay. No, but if you are doing the spread, right, the put spread, and you're doing the credit side of it, right, then even then the maximum loss is limited, right, by the difference between the spreads.
Oh, you exactly right. But now remember, in a credit spread, right? You buy high and sell low, correct?
Mm-hmm.
That difference puts you in a credit. But the exposure, but what is the exposure? Computing. Okay, let's flip these numbers here, for instance, right? Let's flip these numbers. Let's say I sold a 3380 and bought the 3410, right?
Mm-hmm.
Then what you do is I mean, I wish I had my access to my what do you call that? Can I share? I wish I could share my my thesis trade to show you the example itself. I mean, anybody here has a thesis platform? Nani, what do you have?
I use Thinkorswim.
Okay, yeah. Can you bring it up, please? Please bring up your Thinkorswim, please. Let's show him that. That's a good question.
I can give you remote control if you want. I mean,
Sure.
or, so you want to start. So your testy works is it a fact client or a browser based?
I have both. Let me see if I can start by.
Why don't you share browser based?
Let me go there. Hang on 1 second here. Let me 1 second.
I will stop sharing.
Yeah, let me bring up my browser. 1 second. Okay. Hang on 1 second. Okay, so let's go back to here. Advice, share. This thing is a thing. Share
Browser. Yeah, we can see it.
Okay, so here we are. You see this, right?
Yeah.
Okay, good. So, excellent. Let's do this now. Okay, so let's go here. Let me go here, for instance. His question was, for instance, let's take, for instance, okay, simple like, let's say Apple, for instance. Okay? Right? Let's start with the debit, correct? This is the puts. Let me see here. I want to go to the, let me see, what am I? Where are my puts? Where are my puts? Okay, over here. So let's say I want to do a put spread on, let's say, expiring in, let's see here, December 31st, for instance, and I want to do a put spread here. So I want to sell 165, for instance, correct? Then buy 128. You guys see that?
Yeah.
Right?
Yes.
Okay. I'll receive net credit 159. Oh, this account is full. Oh, shoot, this is not good. Let me, 1 second. See if I can bring up the real account. Okay, good. Let's go here. Let's do this trade. Okay, Apple. Go here. What is that account again? Okay. So here is an Apple put spread, correct? I am buying the 157 and selling the 165. Okay, this is my max profit here, 160. You see that?
Yeah.
But this is what I tend to lose, 591. In a credit spread situation, your max loss is always higher than your max profit. Always. Because of the reverse scenario, because of the exposure. Does that make sense?
Yeah, no, because why you are saying, Rene, is because the stock is actually going south. Is that the reason? Because of the loss being higher, and then on the debit spread, the stock is actually going north. So you have the ability to make a little bit more money than the. Is that primarily the reason? Because in this case, you're doing an insurance to make sure if the stock really goes down, you're capping it. Is that right? At
Yeah,
one.
but see what you're talking. So this is what you're explaining. You are explaining this one. This is what you think you're doing. This here is a debit spread. This is a put debit spread here.
Yeah. The other one was a credit spread.
Correct.
Yeah.
In a debit spread, all you can lose is what you put in, but you can make a lot of money if all goes your way. See that? Max loss is my premium. This is how much you can gain because this is a spread.
I got it. Okay.
So can we look at a similar trade on the other side with the call debit?
Absolutely. Let's go on this side here. Okay, on the call side, I'm buying this one over here on the debit, then I'm selling this guy over here. Correct?
So this is $5 spread. So this one is the spread is at $5, right? The other one was what?
It's whatever you want to do it. It's up to you. You can make
Okay.
5. Right?
Okay, I was just trying to find that equivalent one, right? So it's the same spread.
Oh,
if you do that, then what is the maximum loss versus maximum profit?
okay. So let's start that again, right? So let's take, for instance, here. Let's take a $5 white spread. Okay. Let's do a 170 to 175. Right. This is the debit here, right? We're on the debit side, correct? For debit side, my max loss here is 235, and this is my profit 265. Right?
Yes.
And my data is almost nothing. Look at that. Okay, it's very negligible. Now let's reverse that. You want to do what 160? You want to do let's do on this side. Let's do bring this down.
170.
Let's do 170 to 16 to
65. Yeah, 170 to 165. Right?
I don't even think they have 65 here.
No, it's there, right?
170
and 165. Yeah.
to 165, right? Now we are on the credit side, correct? You're doing credit now, correct? Wait, you want to do debit or credit?
No, just the one that you have. You're selling at close to
this is debit. This is a credit spread.
Correct.
I'm selling. I'm selling this one and buying this one, right?
Yeah.
Now look at the difference now. You always have more to lose than to gain, because you are receiving a credit, but this is your exposure. Your exposure is the different the spread width minus premium received. Here you are on a $5. You are on a $5 spread, right? Which is $500 minus 178, which is 322.
Yes.
Right.
That's interesting.
So it's also credit spread is you're bearish for it, right? So you want the price not to reach that your strike price, and then not of a strike price, basically, right? You want your price to be finishing below in a call and above in a put, correct?
In a credit spread, in a put credit spread, you want the price to go up.
Right. You want you want the final price to be outside your strike prices.
Correct. Outside of a short call, of a short put. Correct. You want it to be higher than this.
Right.
And then it will expire worthless. And then you keep the premium. Correct.
Right.
Okay. Now the other side. Now the question you're gonna ask me is, instead of doing a put credit spread, why don't you just do a short call? We see that in the second, in the slides. There are many factors here: the environment, where the stock is in the cycle, and so on and so forth. All right? Does that answer the question?
Yeah, Rene, I have a question.
Yes, sir.
Amazon Leap Call, when you talked about you buy.
Let me show. Okay, good. Let me show you what I mean by it. Let's do the question.
The long leap calls that you buy. How deep in the money do you buy?
I always go at 0.5 delta. Always.
0.5. Okay.
Yeah, 0.5 delta. Because why am I going to 0.5 delta? Because at 0.5 delta, if Amazon goes up by $1, my option goes up by 50 cents. Right?
Okay. Thanks.
And let me show you what I mean by that. I mean, it's a very powerful strategy, actually. Let me show you what I mean by that, right? So Amazon, I agree, it's a very expensive stock. I agree with you guys, right? However, so let's do this. Let's make this exercise. Please get a pen and paper. We'll do it right now in front of everybody so we know what I'm saying. Let's get a pen and paper. I will go out to let's say to January next year, right? January 23, 400 days from now, and then I will buy. Sorry, I'll buy this one here. Okay, I'm putting out $50,000 outlay, correct? You're gonna say, "Wow, that's a lot of money." But let me say why it's not a lot of money, right? Please, let's write that down.
Yeah, Rene, I'm sorry. Like, no, when you go back to the delta, you're not getting on the money, no? So I thought you're getting that looks like on the money. That's
Yeah,
right.
right here. I'm in the money right here. I'm in the money. This is the line. See this line here?
Yeah, no, but I thought like, is it a 80 delta or 85 delta you buy, or you?
0.5. Let me see. Actually, what?
0.5 delta.
No, 0.5 delta is what you buy on the leap option, because I've seen like a lot of recommendations that talks about at a much higher level. No, so is that the recommended? The 50 delta is what is recommended, because you're paying a much higher premium. No.
Okay, for me, this is my preference, right? I don't want to pay more than 0.5 delta because I still want to make money when the stock goes up.
Okay.
If you go up here, that's a very good example, right? Let me clear this. Let me go up here to get let's say I'm going to 0.6 delta. See here, this is 0.6 delta, right? If I go to 0.6 delta here, I'm paying $54,000 in premium for Amazon. See that here? I'm paying $54,000 for Amazon.
Okay, in the other one, how much you're paying when you do a 50 delta?
I'm going down here. I'm going right here. Actually 58 it was. Let me go that way. It's 49, but if I really go down to 50 delta, it's right here. 37,000, right here. 0.51 is basically, I don't go below 0.5. I'd rather pay for 0.51 right here, right? And also, something that's very important, also look at the open interest, okay? Which is the number of contract active there. This, you see this shade here, tells you the open interest. This is a very good strike to be in, because there are many people there in that contract. This is not very good. This is not a very good contract. This is a good contract here. Do you see that? This is the open interest. If I want to buy a leap call here, I will go to this guy over here. I will stick to my line, to my previous choice over here, because here is a very high open interest. I'm paying 50 grand, but bear with me for a second here. Okay, let's write this down. We're gonna buy a January 2022 call, 3,500 call, right? And we're paying $49,000. Are we all there?
So this is Jan 23, right?
Yeah.
Jan 20. Jan 23, correct?
Yeah. 1 year. 1 year and 1 month.
Yeah, plus more than 1 year. Okay. Okay. Now let's hold that thought, right? We're paying 49 grand for this thing. Now let me go back here and show you what I mean. What I do. This is now, because the week is almost over. I'll go here. Okay. We bought a 3,500 call, correct?
3,500, yeah.
I will go to my 0.2 delta over here. I'm going to sell a cover call here at 0.18 delta here. You see that? I will sell this call here and collect that for that week, collect $1,400. You see that? So every week I'm collecting about $1,400 a week in premium. That gives me $6,000 a month in income.
So what is that? That's a 20 delta you do, Rene? That's what you said?
Maximum is 20 delta. Usually I go between 20 and then 0.18. That's because Amazon is what is called a high beta stock. It moves very rapidly, and also a high ATR stock. Amazon, Google, Tesla never sell less than 0.2 delta. Never go above 4.2 ever.
Yeah, but for
Also more than that. Okay.
you know, typically I try to do between 12 and 15. Is that extremely conservative or it is like?
No. See, that you're actually very smart because me, I like taking risk. Okay, I'm a risky guy. I know how to take my risk. Why do I choose 0.2? You see this here? This is my expected move. You see this line here? This orange line that I have on Tasty. It tells me that based on probability and everything we know about Amazon in the next 10 days is going to go up to here at the most. But me, I go like to about higher. Let's say I go to 0.1 later. But you can sell here if you want.
So okay, and actually that's nice. Like no, okay, I have a Tasty Works, but I don't use much. So what you're saying is that the orange bar there, it is statistically showing that last 1 week's curve. Is that what that orange color?
This is the expected move.
I don't know whether it is statistical, but that is the expected.
Yeah. That's based on probability and everything else. You know, that's how I don't know how to do the math there. It says that based on everything they know about Amazon, the IVR and blah and blah and blah, the stock might go up or down.
It's a calculated value, right?
It's a calculated value for that week, Rene, or
for this week, for this expiry.
Okay.
Is it one of the Greeks or is something that they created custom?
I don't know how they do it, man. Those guys, I don't know how they do it, but
yeah, that's great. No, you can't get this in Thinkorswim. I don't see that.
Yeah.
This is a very good indicator for me. I use it all the time.
Yeah, it looks like a cleaner interface than Thinkorswim.
I absolutely. These guys build Thinkorswim. They build a better product.
Yeah.
He's the same guy who built it, right?
Sorry, Rene, a couple of questions. So let us talk about your leap strategy, right? So Amazon leap strategy.
Okay.
And then you are selling calls at 18 delta or something, right?
Mm-hmm.
Then what happens if you get called?
How so?
I mean, anything can happen, right? Stock can move.
You're saying that what happens if the call breaches my strike?
Yeah. If you get called, what will be your strategy?
Well, all I do is, I mean, I can just close my option and then cash out at a higher price. Remember, for you to go from here to here, the stock must move by how much? 35.20 to what? To almost $150.
Yeah.
You're making a killing already on your leap call anyway.
Both positions, yeah.
You're making a killing on the leap call, and then you keep your premium. Win-win. Worst case, you will make a killing.
No, but Rene, there is also a possibility, that the stock can retrieve back to the 35.40, the right next week. So you don't know at that point. Leap option is a long drawn out. Is that right? So, but what you're saying,
that's why leaps are good. Right? Stock can go up and down, but leap is good.
So what you're saying is, with respect to that call, if there's a situation where you have to do, you will take a loss and just close it and move on.
No, if the stock breaches my short strike, I will cash out at this strike price and keep my premium. It's not a loss. Remember, I keep the premium and cash out at the highest stock price.
So Suresh, what he's saying is the 18 delta price is going to be much higher than what you paid for 0.5 delta.
You're making money on
so that means the whole leap option itself.
Yeah, so you will close down the leap option.
Okay. Is that what you're saying, Rene? You'll close the leap option itself and basically close the whole equation and then open up a leap option whenever the price goes down later?
Exactly right.
And the leap option has already appreciated.
Correct. Exactly.
Appreciated quite a bit.
We don't have to do anything here, right? The broker does it for us.
Exactly. The leap option will make money more than you lose here, always.
Okay.
Because if you go from 35.20 here to breach at 36, what is that? 120 appreciation in strike in the stock?
Yeah.
In 10 days.
12,000.
That's insane.
Okay, I got it.
That is an insane move. You can make a killing.
Yeah, but I don't know whether the provider will automatically close the leap option. Is that right?
No, you close it yourself. Okay, by the way, guys.
Do that. The provider would basically do a sell call, the call option. They might close it and they'll ask for more money. They won't close the leap option.
No, I thought
why
they
would
do
they
it.
close it? You cannot close your option, right?
They can't close the leap option.
Guys, let me say this for you guys. If the strike, if the short call is in the money, what you do is you combine them into one transaction. You do a sell to close and then buy to close. You highlight your short call and your leap option. You do sell to close and buy to close. It'll do the math for you automatically. Never leave a position open because the broker they don't like doing the math for you. It costs them money.
I don't know, Rene. I haven't tried that, but I don't know whether in Think or Swim we can combine those two. Technically, they are considered as, even though they have some dependency, I don't know whether you can club it. Probably in Tasty Trade, you can do that. I have not tried it.
Yes, you can do it.
In Think or Swim, I don't know whether we can combine the two different things. We have to do it separately, I think.
In Tasty, you can.
I don't know about Think or Swim, but in E-Trade, what it does is the brokerage will actually assign you your short call, right? So in this case, the 3670. So they're going to give you, they'll credit your account with 3670 times 100 amount, and in your account they'll show you a negative 100 Amazon shares, which you need to fulfill, which you will fulfill by selling off your 3,500 call, which you have the January 2020.
But why do that anyway? It's just too much headache for your broker. I mean,
true.
But
quick question though.
Yes.
So say you do this. Say you bought this call today, right? So you got it for say 54,000, right? And you do that for say another 10 weeks, right? At what point in time do you close your January 2023 call? Because that's going to eventually lose money over time if Amazon remains in the 3,500 range, correct? It's going to be worthless by the time it reaches January 23.
I close my options. I close my lead calls either at 21 days or when my money has doubled.
In 21 days or okay.
You know, at 21 days to expiration or when my money doubles, I get out.
Gotcha. So you basically do 3 rounds of covered calls and get out.
I can do 10. I just keep collecting. Remember, each covered call lowers your cost basis. Remember that.
Right. I know what you're saying. Yeah.
Before expiry is what you mean, right, Rene? 21 days before expiry. Let's say in January 23, then you will close it in December 2020.
Correct.
2022. Sorry.
Correct. But remember, every week I'm collecting $1,500. It lowers my cost basis every single week. So basically, my option becomes cheaper and cheaper and cheaper over time.
Right. And if Amazon in this case is 3,500 plus the 50 grand you paid, you are anyways in the money, so that makes sense.
Correct.
Okay, gotcha.
That's why I buy that exactly now. That's why I'm in the money here.
Yeah.
That's why I start here.
Yeah. Okay. Yeah. Gotcha. Makes sense. Thank you.
You don't lose. I mean, if you have a leap call and at a 0.5 delta, and then you're selling premium weekly, it's very hard to lose money on that thing, unless we have like some kind of COVID type crash that we had last year, or something crazy happens.
Gotcha.
So what would be the premium? I don't know. In the case of Amazon, what is the premium that you're paying for the leap option between the on the money versus the 65 delta?
We saw that, right? It's
around 10% of the stock value.
I mean, okay, you want to buy Amazon right now?
I'm talking about the spread. Is that right? There is when you do a buy, I think if I add the strike price to the premium, it's much higher, no? At a 50 delta?
No, sorry, I don't understand the question. Sorry, what's the question? I don't get it.
No. If I'm paying for a leap option, basically it's a strike price plus the premium. Is it right? So in this case, let's say
correct.
So if I go with a 65 delta, the total cost is much lesser than the 50 delta. At what point I'm paying the total cost that I pay for the leap option, including the premium cost?
I mean, upfront.
Yeah.
When you buy your leap option, let's go back there. What was that again? We were Jan what? Was it Jan 23?
Yeah, Jan 23. It
was right here. We were right here, right? Sorry. You see it here. It tells you this is how much you're paying right here. It's right here. Because right now, I mean, they're closed. I mean, they won't show you how much it costs in terms of transaction cost. But this is how much you pay out of pocket plus whatever it will cost you in terms of commission here.
So what you're saying is the total outlay of cost what you're paying is the lowest of the 50 delta.
Lowest of the 50 delta.
What do you mean lowest?
Yeah, I don't get it.
Because as you go up the delta, is it right? Your premium is going to change. Your strike price is going to change. right? So basically, the premium, technically, it's the strike price plus the premium. It
is the option price plus premium. Yeah, that's a capital outlay upfront. Yes.
Yeah. So the 50 delta would be the lowest point, Rene, or
I don't quite understand the question.
yeah.
Sorry.
For example, no, if you want
as
to
you go deep in the money, you will end up paying more premium, right? And then the overall cost, if it were to be assigned.
Yeah,
okay.
exactly.
Okay, so if you go buy over here, if let's say you're buying somewhere around here.
So yeah,
okay?
If you look at the 3410, I'm taking a strike price of 3410 and I'm paying a premium of whatever that 500 some bucks. So technically it's 3410 plus that 525, no?
It's right here.
Okay, that's yeah.
But why are you adding the stock price and the premium?
Yeah, there is not.
No, because so technically if I don't close the leap option and if I wait for a year, then I should cover the premium, no? The difference that at least I should cover that.
The moment you're in the money, you're already good.
You're covering it by selling calls every week.
Yeah, in this case.
Actually, when you're in the money, you already cover your how do you call that? Your commission.
Yeah, you're not obligated to buy it, right? You can close it beforehand and you can get your premium back, right? More or less.
Okay.
I think I know where he's going with this question, and what I mean, he's looking at look at the big picture, right?
Yeah.
Look at the big picture. So you are focused on basically let's take crypto here, the gas fee.
Yeah.
You focus on the gas fee.
Yeah, no, for example, like so today the strike price is 35.23.
Mm-hmm.
Is that right?
Right.
When I'm buying a leap option a year from now,
mm-hmm.
I'm paying a premium for it. Is that right? Because I'm buying it.
So, now I got your question.
Yeah, so I'm paying a premium of not the today's price. I'm paying the price like 12 months from now. So they're going to add a premium. Is that right? And when I buy the premium is actually differing based on the delta.
Okay,
you're talking about time value.
Exactly, theta.
Yeah.
I was getting there.
Right? You're talking about theta.
You are paying for the extrinsic value of the option.
Yeah.
Extrinsic value, yes.
Yeah.
That's what you're paying for. You're paying. You buying more time. Yeah, that's what they're doing. Yes. Now, now I got your question. Yes.
Yeah.
Yeah.
Correct.
Coach, I have a couple of questions here. Right?
Sure.
First is, have you tried this with SPX or in any of the ETFs?
This can leap option.
Yeah.
No, when it comes to leap option, I trade Amazon in leaps only Amazon.
Okay.
But you can do SPX too if you want to, because
How about the spreads?
Yeah. Let's try SPX. We can.
The reason I'm saying is like because of trading restrictions at my company, I can only do ETFs.
SPY, then SPY, not SPX.
No, SPX is better. It's more
index. Yeah, index option.
It's very liquid, very liquid.
Yeah.
Now,
it's like in terms of cost, it's similar to Amazon, right?
Actually, it is. I would say it's even like almost more than Amazon, actually.
More, yeah. Because it's. Yeah, I think SPY may be better.
Hey, Rene, one question. Maybe it may be dumb for the other people.
It's okay.
So, if I have purchased a call, Amazon call for 3,500 strike price, say January 23, okay? And I paid like $450. Now you are saying that you can sell the weekly calls, right? On this, how can we do that?
Okay, it depends. Let me just say this upfront. If your platform allows it, because some platforms don't allow it.
Yeah, Thinkorswim allows.
Tasteseek allows. What you're doing is you have basically your asset, your collateral is what's important. Because when you buy, okay, instead of buying the shares, buy hundreds of Amazon, which costs a lot of money, right? You buy one option, which controls, let's say in this case here, 69 shares of Amazon, correct? Now, when you're going to sell a call, they look at your account. Do you have any kind of Amazon asset that can cover the cost of that call you're selling? The answer is yes. It is your leap call.
Okay.
That's on Tasty. I don't know what other brokers do out there, but that's what Tasty does it. And I do it.
I have to check with the E-Trade whether that's possible or not.
I mean, Tasty was designed for options trader, by the way.
Yeah, E-Trade allows that. I've tried that.
Okay, good.
Yeah, they treat like a leap option that you already have the stock, so they allow you covered calls.
It is all based on the value of what you're trying to sell, right? If you own $1,000 in your account, you're selling something for $500, they allow it to happen. They will allow it because you have the collateral.
I had a question regarding Thinkorswim.
Sure.
Rene, you showed the possibility of the maximum loss and maximum gain for these spreads, the vertical spreads that you're talking about. Is it possible to show the same thing in Thinkorswim? Maybe not right now. Maybe somebody else can show that as well.
Okay, let's go there.
When you order.
Yeah.
Okay.
So
let's go there. Hang on.
So while we are on this leap strategy, right? Can we talk about the downside of this? Like what are the possible downsides for this strategy?
Okay. If you are on a leap option, the downside is like the company just drops, like something happens. Maybe I don't know, maybe they go bankrupt or it's some kind of scandal. The stock loses half the value, something, right? Like that's one of the downsides. I mean, nobody can predict the future, right? Everything being equal, if I buy Amazon stock because I know that Amazon is a good company, or Facebook, or Google, or Apple, correct?
So you can go in an index, right? In that case,
you can do index as well. Yeah, SPX is one of them. You can do SPX.
No, so if we are buying this at 50 delta, right? So we are kind of just in the money, right? If you're doing that, and if the stock price goes down, let's say in this case, let's say we bought 46.85, right? And then stock drops down to 4,500. Are we still allowed to sell calls, that weekly calls, even though we are out of the money with our own?
Yes, as long as you sell out of the money calls, and then yes, you are, of course.
Because our leap itself is out of the money, right?
It doesn't matter. I can buy a leap. Okay, that's a very good question. I can buy a leap here. I can buy a leap right here at 4,800 right here, right? This is out of the money. I can buy a leap here, and then sell covered calls at let's say at 4,925. I can do that. Yeah. Because as long as you always sell covered calls out of the money, always, which is above your long strike, always.
Yes, that I got, but okay, I wasn't sure what happens if our leap that we bought itself is out of the money. So
no,
that is allowed. That's great.
You can always sell call options against a long leap option, as long as your leap option, I mean, has more value than what you're selling. You can always do that.
So the 50 and the 18 delta, like is that like a most of the rule that's specifically for the big guys like Amazon, Google, or you would also use it for generally as a yardstick for the other companies as well?
For Amazon, Google, Tesla, I go like around like the 0.15 delta, 0.2 delta at the most. Those are fast. They move fast, high and low quickly. Let me show you here. Let's look at something here. Let me look at some. Can you guys see this screen?
Yeah.
Okay, let's go here. Look at Amazon here, right? And I will show you something here. Look at the ATR of Amazon right here. This is ATR. You see that here, the ATR? Okay.
Yeah.
This tells you by how much a stock can move up or down within 14 days. Okay.
And what site is this, Rene?
Finviz.com.
Oh, Finviz. Okay.
Yeah. It tells you by how much a stock can move up and down over 14 days. This is the average.
Is that dollar amount 104?
Yes, this is dollar amount. Yes.
Okay.
Okay. Amazon can move up and down, but on average, $100 in 14 days. Some days Amazon go up to $100. It does, right? So by going to 0.2 delta based on TST's math, you see what I mean? Based on the math, this is the expected move. Of course, it's not guaranteed. It's not. Okay? It's not. But that's why they tell you based on anything they know at the time. That's why I go to point two data. Let me go back here to Amazon and look at something for you. Hang on.
There is the question that someone asked, right? What if the price of Amazon drops? The risk in that is you always want to sell the covered call higher than the strike price at what call you got, right? So in this case, you got the call for 3,500, and if Amazon drops down to say 3,000, then if you're going to try selling something for 3,600 as a covered call, your premium is going to be very, very minimum. So then you are trying to, and you don't want to sell something which is less than 3,500, because if you get called, then you're going to be at loss, right? Because so that's the risk. So like for PayPal, right? A lot of people got calls at 240, 236 when it was stabilizing, and then it dropped to 170. Now they are basically waiting for it to cover the $60, and your call cost itself, you can't do any calls more than 230 because you're going to get peanuts for it. So that's a big risk. Not a big risk, but that's a risk. That's one risk as compared to So that's something.
So, and if it stays like that for an extended period of time, you don't have a chance to make up for that premium that you paid originally.
Right, but I think
that's why I lead call.
Yeah, the lead call allows you it gives you the leverage of time, right?
Yes,
that's what it gives you. So
absolutely. I mean, I don't fear a stock dropping on me on a lead call. I don't worry about it. If you're dealing with a good company,
in the short term, it will be okay, right? So if it's like a month or so, it will be okay. But if it goes for like 5-6 months, then that's.
Believe me, if Amazon goes down for 5-6 months, you have a lot of people angry. Okay, you're gonna have a lot of people angry. Believe me. Okay, not gonna listen. Everything is possible, right?
Yes,
Risk
yes.
is measured, and nothing is guaranteed in life.
Right. No, absolutely. I mean, this seems good, right? It's very good.
I've been doing this.
Just wanted to understand like what are the possible downsides, and I think Rahul is the one talking. He put it really well.
Yeah, we have a similar strategy presented by Bala also. We have the video in our website. And under the stock options tab, if you look at the fourth video, I think fourth video, it says option strategies. So this is the strategy that Bala presented.
Covered call.
Yeah, buy a leap call and sell calls on that. So that is the strategy he presented.
Nari, can you share the website address, please, on the chat here?
It is in our group description. If you go,
okay.
The website name is there.
Okay, got it. Thank you.
Okay, so where were we again? Okay, so while I'm here, let's. I want to talk about. But the people who came late here, the old issue of business of Delta and whatnot. And that was I was trying to illustrate there earlier. I think I showed it earlier in the slide. Nari, do we have time?
Yeah, I think we generally wind up in 90 minutes because people.
Okay, well.
So, yeah, I think we are good for today. So if you guys want to understand Delta and Theta, this recording is there. You can watch it later. And also in the same presentation that I mentioned about Bala, he also covered Delta and Theta. But I'm not sure whether he covered Vega, but he definitely covered Delta and Theta.
Next week, we're going to pick up and then keep talking about the spreads and then that kind of stuff.
Yeah, Rene, next. Do we continue next Tuesday? Is it okay?
Yeah, of course. Yeah, next week.
Okay, next Tuesday. Let us continue next Tuesday, same time, 8 o'clock.
Absolutely.
And then maybe if you can join a few minutes before, we will sort out that presentation.
Yes, I was trying to figure out what's on my computer here. It's just terrible. I figured it out. So sorry about that. I'm really sorry.
Just join like 7:45 or something. We will sort out the presentation issues.
We will certainly.
Okay. At some point, this is great, Rene, and at some point, I think if we can show some tips and tricks with respect to Tasty Works, that would also be helpful.
Okay, I am no expert in Tasty, but I'm using it for a long time now. I know enough to be dangerous on that.
Yeah, Tasty Works it's a trading platform, right? So you have to open an account there and all that.
Yeah, no, I have it. No, I have it for almost a year now, but I have not used it much.
Oh, it's great. I'm telling you, if you're going to trade options, use Tasty. If you have Tasty, use it. Believe me. It's a great platform for.
Or I'll set up some separate time, like 15-20 minutes now, just to quickly understand some tips and tricks. That's
if you go to YouTube, right, they have plenty of tricks there. YouTube
yeah.
Plenty.
Yeah, let's not disturb him for some small things.
Okay.
Yeah, no, I think this is great, Coach Rene. They really appreciate your insight into all these
I hope
things.
that you guys were able to
I
get
think
something out of
probably
this.
some people it may be a bit above, but what I suggest is, if you did not follow this, go through the previous videos I presented, Bala presented, and then watch this again. This will make a lot more sense. Okay, so don't think that you did not catch some of this, because the videos are there. Go to that site which is in the group description. Watch all the options video that we have compiled. This is like a fifth presentation on options, right? So we have done a lot of presentation. Go through all those things and then it will become much clearer.
Thank you very much, Narayan, for organizing this, and Rene, thank you very much for giving this. And I will go through all other videos. Thanks a lot. I really appreciate it.
But next time we'll get
looking
it
forward to more info on the spreads, Rene. Thank you.
Thank you, Nari and Coach Rene.
Next Tuesday we'll be here.
Yeah.
Thanks everybody.
Thank you.
Guys, appreciate it. Good night.
Thank you very much. Wonderful session.